Amanda McConey and welcome back to the Tax Studio Sessions. In today's episode, we're going to be diving into one of the biggest events of the year in finance, the autumn budget. The autumn budget was delivered on the 30th of October by Rachel Reeves at around 12:30pm. The decisions made in this budget affect everyone, from employees, small business owners, people on benefits, and even students and retirees. So in today's episode, we'll break down exactly what these changes mean for you, how they impact the economy, and offer some practical strategies to adapt to these shifts as best as possible. So buckle up, because understanding these changes could make a huge difference in your financial well-being. So what exactly is the autumn budget? Twice a year, the UK government sets out its financial priorities and allocations. The autumn budget is especially specific because it adjusts spending and tax policies that impact nearly every facet of the economy, from individual income to business profitability and even public services. In this year's budget, the budget has announced shifts aimed at addressing economic challenges like inflation, public debt, and the cost of living pressures that we've all been facing. So some key points that we saw in the budget and how they particularly impact individuals. The first one that we saw was the income tax threshold adjustment. One of the major announcements concerns income tax. This year, we're seeing a freeze on income tax thresholds, which means that as wages increase even slightly, more people will be moved into a higher tax bracket. This is known as a fiscal drag. So, for example, if you're earning close to the basic rate threshold of £12,570, a small pay increase could push more of your income into the 20% bracket. Similarly, for those near the £50,270 threshold for the 40% rate, you might find yourselves paying significantly more tax if your income rises. So say you're earning £50,000 and you receive a 5% raise. That means that your income would effectively be £52,500 a year. That extra income pushes you into the higher rate tax band, increasing the portion of your income that is taxed at 40%. It's important to budget accordingly and, where possible, use tax-efficient savings and pension contributions to reduce your taxable income. We also saw a change in national insurance contributions. There was an increase in national insurance contributions for both employees and employers. For those who are employed, the rise means slightly lower take-home pay, with both employee and employer contributions edging up by around 1.25%. For self-employed individuals, Class 4 contributions are also set to increase. So one tip that I would have in this situation is that you may consider adjusting your salary structure or utilising your salary sacrifice schemes for pension contributions to reduce the national insurance liabilities. Those of you who are self-employed, you might look into exploring allowable business contributions or consider incorporating, because this may help you manage the increase in costs. We also noticed a change in the personal allowance for higher earners. Personal allowance, as we've sort of broken down before, is the amount of income that you earn that is tax-free. When you're a higher earner, this is tapered even further for those earning over £100,000. For every £2 of income above £100,000, your personal allowance is reduced by £1. This is effectively a stealth tax, as high earners could end up with a marginal tax rate of over 60%. Higher earners should consider methods like additional pension contributions or even charitable donations to reduce your taxable income. This will help you to retain more of your personal allowance and will help with that marginal tax rate increase that you could potentially face. In this autumn budget, we also noticed an impact on benefit and social welfare recipients. The government has announced a modest uplift in universal credits to keep up to pace with inflation. However, as inflation continues to rise, the values of these benefits may still fall short of the real living costs. Additionally, the eligibility criteria and the taper rate, which is the rate at which benefits reduce as you earn more, still remain a challenge for many people. There was also an energy cap extension. This means that the government will continue to support households with high energy bills, which is particularly crucial for those on lower incomes. The energy price cap extension means the government will absorb some of the cost increase, but users should still be prepared for potentially volatile energy costs, especially as we move over into the colder months. For those on benefits, it's essential to explore any available hardship funds and local council schemes that provide additional support. This budget also affected business owners and corporation tax. Businesses face a rise in corporation tax to 25% for profits over £250,000, while smaller businesses with profits under £50,000 will continue to pay at 19%. Companies with profits between £50,000 and £250,000 will pay a tapered rate. For small and medium enterprises, this rise is likely to tighten your budgets, especially as costs like energy and materials still remain quite high. Businesses may consider reinvesting profits into allowable expenses or into R&D projects which can qualify for tax release. The R&D tax scheme, for example, can offer significant savings for companies involved in innovation. We also note a dividend increase. Directors of limited companies should take note of the increased tax on dividends. The dividend allowance has been reduced, meaning higher tax liabilities for those who pay themselves in dividends. The budget also showed us some special measures and reliefs. These include things like electric vehicles, house markets, and many other changes. So, in an effort to promote sustainability, the budget included an incentive for electric vehicles. The government will offer a 100% first-year allowance for companies purchasing electric vehicles and installing charging points, allowing businesses to reduce the full cost from their profits. In terms of the housing market, the government extended certain stamp duty reliefs for first-time buyers. Though the impact may vary regionally, this will potentially help first-time buyers to save on upfront costs, though ongoing inflation could still affect mortgage rates and the affordability of buying a first home. So how can we all adapt to these budget changes? As the cost of living continues to rise, now is the time to create a robust budget. Consider consolidating your debts, exploring cheaper service providers, and maximizing reward programs on regular purchases. It may also be worth investing in ISAs or pensions, as these still remain one of the most tax-efficient strategies for individuals. With the freeze on tax thresholds, it is wise to use these accounts to shield more of your income from tax. Thank you so much for tuning in to this special episode of the Tax Studio Sessions. The autumn budget always brings changes that ripple throughout our personal and professional lives, and staying informed is one of the best ways to protect yourself and to adapt to these new rules as best as possible. Join us next time as we dive deeper into tax planning strategies tailored to your unique circumstances.